If you have been watching the financial markets lately, you have probably noticed that the massive high-flying artificial intelligence trades are starting to look incredibly crowded. The household names that carried the market for the last couple of years are facing intense scrutiny as investors begin to ask hard questions about when the trillions of dollars in capital expenditure will actually translate into bottom-line profits. The smart money is not abandoning the artificial intelligence trade at all. Instead, it is quietly rotating. Institutional capital is moving one layer deeper into the infrastructure stack, targeting the fabricators, the connectors, and the power specialists that act as the physical picks and shovels of this three hidden AI infrastructure stocks Wall Street is buying now. The first company on my list is Celestica, which trades under the ticker symbol CLS. Celestica is what the industry calls an electronic manufacturing services, or EMS, provider. If you are not familiar with the term, think of them as the highly specialized engineers and fabricators who build the actual physical hardware that goes into massive data centers. When a hyperscaler wants to deploy custom artificial intelligence servers, advanced network switches, or complex storage arrays, they do not build these physical machines themselves. They design them, and then they hand those complex blueprints to an EMS provider like Celestica to actually build them at scale. The document notes that Celestica is the hyperscaler EMS story hiding in plain sight, and its recent financial results prove that business is absolutely booming. According to Celestica's second quarter earnings report, which was released on July 27, 2026, the company delivered a decisive statement to the market. They reported quarterly revenue of $4.70 billion, which represents a staggering 62.4% increase year over year. But the real driver of this growth becomes obvious when you look at their Connectivity and Cloud Solutions segment. This division, which directly services hyperscaler artificial intelligence demand, posted revenue of $3.81 billion for the quarter, marking an 84% increase year over year. The report emphasizes that this was not a one-time fluke. Celestica's adjusted earnings per share came in at $2.54, marking the fifth consecutive quarter where the company beat Wall Street's consensus expectations. Because of this intense operational momentum, Celestica's management did not just celebrate a good quarter, they actively raised their guidance for the rest of the year. The document details that management now expects full-year 2026 revenue to reach $20.5 billion, with adjusted earnings per share climbing to $11.30. If they hit these targets, it will represent 65% revenue growth and an 87% increase in earnings per share for the year. Celestica's chief executive officer, Rob Mionis, addressed this directly, stating that driven by their strong first-half performance, strengthening second-half customer forecasts, and improved component supply, they are pleased to once again raise their 2026 annual outlook. This is a crucial point because it tells us that the supply chains supporting these massive data center buildouts are finally smoothing out, allowing Celestica to convert its massive backlogs into realized revenue much faster than before. What makes Celestica such a compelling setup for August is the current market technicals described in the report. Shares are currently sitting around $331.44 after experiencing an 8.35% pullback in July. This pullback has created a highly attractive entry point, especially when you consider that the stock is still trading 65.84% higher over the past year, showing strong underlying relative strength. The report points out that institutional analyst positioning on Celestica is incredibly lopsided. Right now, there is a 95% bullish sentiment among Wall Street analysts, with 20 buy or strong buy ratings, only one hold, and absolutely zero sell ratings. The consensus price target for the stock is $466.56, which represents significant upside from current levels, especially when you look at its 52-week trading range of $173.23 to $474.02. However, the analysis does not shy away from the real risks associated with Celestica. The report notes that customer concentration is a very real hazard for this business model. When a massive portion of your revenue comes from just a handful of hyperscalers, any shift in their spending patterns can have immediate consequences. For example, if a single major cloud provider decides to push its next-generation 800 gigabit or 1.6 terabit optical transceiver switch program out by a quarter or two, Celestica's revenue could easily slip for that period. Furthermore, the report mentions that Celestica has exposure to the International Emergency Economic Powers Act, or IEEPA, tariff regulations, which remains an open question that investors must monitor closely. If trade tensions escalate or tariff structures change, it could put pressure on their manufacturing margins. Despite these risks, the sheer volume of capital flowing into the connectivity and cloud space makes Celestica one of the most fundamentally supported players in the entire hardware ecosystem. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on these detailed deep dives into the hidden mechanics of the stock market. The second stock on our list is ON Semiconductor, which trades under the ticker symbol ON on the Nasdaq. Unlike Celestica, which is experiencing clear, uninterrupted upward momentum, ON Semiconductor is a classic post-trough cyclical recovery play with a massive artificial intelligence kicker. The report explains that the market still largely associates ON Semiconductor purely with the automotive industry, specifically electric vehicles. This perception gap is exactly where the opportunity lies for forward-looking investors in August. The semiconductor industry is notoriously cyclical, and ON Semiconductor has spent the last year navigating a brutal downturn. In the full year of 2025, the company's revenue fell by 15.35%, landing at an even $6 billion as automotive and industrial customers worked through excess inventory. However, the document highlights that the company's first quarter 2026 earnings report delivered the first definitive sign that the cycle has turned. ON Semiconductor reported revenue of $1.513 billion, representing a 4.7% increase year over year. While a 4.7% growth rate might look modest compared to Celestica's explosive numbers, it is incredibly significant because it represents the company's first positive year-over-year revenue growth print after a long, painful contraction. The company's chief executive officer, Hassan El-Khoury, was very direct about this turning point. He stated that they exceeded expectations as demand strengthened through the quarter, and they have officially moved beyond the cyclical trough on a path to recovery. More importantly for our thesis, he revealed that their artificial intelligence data center business accelerated significantly, growing more than 30% sequentially. This sequential growth rate is where the narrative around ON Semiconductor starts to shift. The report explains that while the broader market is still waiting for a full automotive recovery, the company's artificial intelligence data center business has actually more than doubled year over year. Powering modern artificial intelligence chips requires an immense amount of electricity, and managing that power without melting the silicon requires highly advanced specialized power semiconductors. ON Semiconductor's Power Solutions Group posted $736.6 million in revenue for the quarter, up 14% year over year, driven largely by this trend. The document explains that the company is seeing massive traction with silicon carbide or SiC and gallium nitride or GaN technologies. If you are not familiar with these materials, they are wide bandgap semiconductors that can handle much higher voltages, temperatures, and frequencies than traditional silicon, making them incredibly efficient for both electric vehicles and high-density data centers. ON Semiconductor has secured major 900-volt electric vehicle architecture wins with prominent automotive players like Geely and NIO, while simultaneously forming strategic gallium nitride partnerships with Innoscience and GlobalFoundries to deliver high-efficiency power directly to hyperscaler data center grids. Looking at the stock setup, ON Semiconductor is currently trading at $81.61. This price puts it up 50.71% year-to-date, but it represents a 13.76% pullback in July, offering a much more favorable entry point than the peak we saw in June. Interestingly, the report mentions that even the retail sentiment reflected in decentralized forecasting platforms like Polymarket is highly constructive, showing a 95% implied probability that ON Semiconductor will beat its next quarterly earnings per share expectations. This shows that while the mainstream financial media may still categorize ON Semiconductor as a sluggish auto chip play, the more analytical corners of the market are fully aware of the recovery underway. Of course, a cyclical turnaround is never entirely smooth, and the document outlines several key risks that investors need to weigh. The recovery process has not been cheap. ON Semiconductor carried $329.3 million in restructuring charges during the first quarter of 2026 as they consolidated manufacturing facilities and streamlined operations. Additionally, their analog and mixed signal segment is still showing weakness, down 5% year over year, indicating that certain legacy industrial markets are taking longer to recover. Wall Street is also somewhat divided on the near-term outlook. Barclays recently initiated coverage on the stock with an equal weight rating and a $75 price target, citing concerns over persistent China exposure and the slow pace of the global automotive recovery. Furthermore, the report notes that the company's share buybacks are running at a massive 160% of their free cash flow. While returning capital to shareholders is generally seen as a positive, spending significantly more on buybacks than the business generates in free cash flow is an aggressive capital allocation strategy that deserves close scrutiny. If the recovery stalls, that level of buyback spending will simply not be sustainable. However, if the cyclical recovery in autos aligns with the explosive sequential growth of their artificial intelligence power delivery business, ON Semiconductor represents a highly asymmetric recovery play that the market is currently mispricing. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. This brings us to the third and final stock on our list, which represents the purest and perhaps the highest beta play on the physical limitations of artificial intelligence architecture. This company is Astera Labs, trading under the ticker symbol ALAB on the Nasdaq. To understand why Astera Labs is so critical to the current build-out, we have to understand the fundamental engineering problem that modern data centers are facing. We have spent the last 2 years focusing almost entirely on the graphical processing units, or GPUs, made by companies like NVIDIA, but a GPU is only as good as its ability to receive and transmit data. When you link tens of thousands of GPUs together to train a massive large language model, the physical cables and connectors linking those chips become a massive bottleneck. If the data cannot move between the processors fast enough, those incredibly expensive GPUs sit idle, wasting power and computing capacity. Astera Labs solves this exact problem by designing specialized connectivity solutions, specifically PCIe retimers and smart cable modules which boost and clean up data signals as they travel across the motherboard and between server racks. The document argues that Astera Labs' Scorpio X-Series product ramp is the specific catalyst that investors should be watching closely throughout August. Looking at their first quarter 2026 financial results, the growth trajectory of this business is nothing short of remarkable. Astera Labs reported record quarterly revenue of $308.36 million, which represents a 93.4% increase year-over-year and a 14% sequential increase from the previous quarter. Their non-GAAP earnings per share came in at 61 cents, marking their fourth consecutive quarterly beat since going public. But the most impressive metric in the report is their cash flow generation. Astera Labs' operating cash flow surged by a staggering 610.19% year-over-year, reaching $74.6 million, while their gross margins expanded to an incredibly high 76.3%. This gross margin profile is closer to a high-margin software company than a traditional hardware manufacturer, reflecting the immense proprietary value of their connectivity intellectual property. The company's chief executive officer Jitendra Mohan pointed directly to this, stating that they are seeing robust demand for their PCIe Gen 6 portfolio as the primary engine driving their growth. But the strategic story for Astera Labs goes far beyond a single quarter of high-margin growth. The document explains that Astera is aggressively targeting what is known as the merchant scale-up market, which is projected to reach $20 billion by the year 2030. The primary catalyst for this expansion is their Scorpio X-Series 320-lane fabric switch, which is scheduled to enter high-volume production in the second half of 2026. This product allows for seamless, high-speed communication between massive clusters of accelerators. Furthermore, the company is deeply integrated into the industry's leading open standards, collaborating closely on the UA-Link 2.0 specifications, and developing custom integrations for NVLink Fusion, which is NVIDIA's proprietary high-speed interconnect technology. By positioning themselves as an essential partner to both open standard consortia and proprietary ecosystems like NVIDIA's, Astera Labs ensures that no matter which chipmaker wins the architectural wars, their connectivity silicon will be required to make the system work. From an investment perspective, the setup for Astera Labs in August is highly opportunistic. The stock is currently trading at $311.23. While that represents an 87.08% gain year-to-date, the stock suffered a massive 27.77% drawdown in July, falling well off its 52-week high of $499.48. The report argues that this sharp correction, occurring right as institutional analysts are actively lifting their 2026 revenue forecasts by roughly 13% to $1.3 billion, represents a classic valuation disconnect. The fundamentals are revising upward, while the stock price has experienced a significant technical correction, creating a prime window for long-term investors to build a position. However, the report is very explicit that Astera Labs is not a stock for the faint of heart. Its current valuation leaves absolutely zero room for operational errors. The stock trades at a trailing price-to-earnings ratio of 243, and it carries a beta of 3.67. For those unfamiliar with beta, a reading of 3.67 means the stock is over 3.5 times more volatile than the broader S&P 500. When the market rallies, Astera Labs will likely rocket upward, but when the market experiences a correction, this stock will get hit significantly harder than the average equity. Additionally, the company has guided for some near-term gross margin compression, expecting margins to decline to roughly 73% in the second quarter as they ramp up lower-margin physical cable modules. There is also the issue of dilution. The company is currently issuing $48.9 million per quarter in stock-based compensation to attract and retain top-tier engineering talent. If a major hyperscaler decides to delay its order book even slightly, this high-multiple, high-beta stock will be punished swiftly and severely by the market. The report suggests viewing Astera Labs as a much higher beta, high-leverage expression of the exact same physical infrastructure thesis that Celestica and ON Semiconductor offer at more grounded, stable multiples. When we look at all three of these companies together, we can see a clear picture of how the artificial intelligence theme is evolving in the second half of 2026. The initial phase of the artificial intelligence boom was defined by buying the obvious chipmakers and cloud platforms, but as those trades have become incredibly crowded and expensive, the sophisticated institutional players are looking at the physical constraints of the build-out. They are asking, how do we build these massive structures? The answer leads them to Celestica. They are asking, how do we power these massive structures? The answer leads them to ON Semiconductor. And they are asking, how do we connect the chips inside these structures to prevent massive processing bottlenecks? The answer leads them to Astera Labs. Each of these three companies addresses a fundamental physical limitation of the artificial intelligence build-out, making them essential beneficiaries of the hundreds of billions of dollars in capital expenditure that Morningstar and Goldman Sachs have highlighted. By focusing on these deeper layers of the technology stack, investors can position themselves ahead of the next major wave of retail awareness. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.